This is Striving Aspirants. Welcome back again to our channel. This video presentation is the continuation of solvency ratios. In the first part, we have seen debt equity ratio, debt ratio, and proprietary ratio. Those who want to see the first part, I have given the link in the description below. You can access the same. In this video presentation, we will check the other ratios under solvency ratios, which include total assets to debt ratio and interest coverage ratio. Let us check what is total assets to debt ratio. Total assets to debt ratio is the relationship between total assets and long-term debt. In other words, we can say it measures extent of the coverage of long-term debt by available assets in the company. Formula to calculate total assets to debt ratio equal to total assets divided by long-term debt. Let us look into one example in order to understand this total assets to debt ratio. We have given with one balance sheet here. Let us check the liabilities and assets given here. Liabilities: preference share capital 2 lakh, equity share capital 8 lakh, reserves 1,10,000, debentures 1,50,000, current liabilities 1,40,000 will give the total 14 lakh. Now we will check the asset side. We have plant and machinery 5 lakh, land and building 4 lakh, motor car 1,50,000, furniture 50,000, stock 1 lakh, debtors 90,000, cash and bank 1 lakh, discount on issue of shares 10,000 will give the total 14 lakh. Now we will apply the formula to calculate total assets to debt ratio. The formula is total assets divided by long-term debt. First we calculate total assets. We will check the asset side: plant and machinery, land and building, motor car, stock, debtors, cash and bank. These items we will take, and we will take the amount also, which is 5 lakh plus 4 lakh plus 1,50,000 plus 50,000 plus 1 lakh plus 90,000 plus 1 lakh will give 13 lakh 90,000. That is the total assets. We can see discount on issue of shares 10,000 in the asset side. That one we will not take into consideration while calculating total assets. Now long-term debt. Here the long-term debt is debentures and the amount is 1,50,000. Now total assets to debt ratio equal to 13,90,000 divided by 1,50,000. That will give 9.27, and that is the total assets to debt ratio. Here we can see the total assets amount is 13,90,000 and the long-term debt amount is 1,50,000. So we are in a situation to cover the long-term debt with the available assets. Let us check some points related to total asset to debt ratio. When there is a high ratio for total assets to debt ratio, it indicates that the funds are mainly financed by the owners of the business, and the long-term debt is adequately covered by assets. Means we have enough funds to cover the long-term debt. This ratio indicates the rate of external or the outside funds taken into consideration for financing the assets, and also the extent of coverage of their debt with the available assets in the company. Now we will check the next one, interest coverage ratio. This ratio deals with the servicing of interest or paying back the interest on the long-term debt taken by the business. It shows the relationship between profits available for payment of interest and the amount of interest payable. The calculation or the formula is net profit before interest and tax divided by interest on long-term debt. This ratio reveals the number of times interest on long-term debt is covered by the profits available for interest. A higher ratio ensures safety of interest payment debt, and it also indicates availability of surplus for shareholders. Let us see one example to understand interest coverage ratio. These are the given information. Net profit after tax 60,000, long-term debt 15%, tax rate 40%. First we will calculate net profit before tax. Formula is net profit after tax multiplied by 100 divided by 100 or 100% minus tax rate. So the amount is 60,000 multiplied by 100 divided by 100 minus 40 or 100% minus 40%. The amount we will get 1 lakh. Interest on long-term debt, that is equal to 15% of amount 10 lakh equal to 1,50,000. Net profit before interest and tax equal to net profit before tax plus interest. So the amount will be 1 lakh plus 1,50,000. The total is 2,50,000. Now we will apply the formula. Interest coverage ratio equal to net profit before interest and tax divided by interest on long-term debt. The amount is 2,50,000 divided by 1,50,000. So the ratio is 1.67 times. That's all about the solvency ratios. Subscribe our channel and support us. Thank you for watching this video. This is signing out from Striving Aspirants. Bye bye.